Today I want to talk in terms of the outlook for US inflation as published by the Cleveland Federal Reserve. Loretta Mester is the person who runs that. And I want to talk about my updated model for the ASX 200. There is a view that we just had a good CPI and the Fed will react to that by moving more slowly on US interest rates, particularly its increases in the Fed funds rate. Rather tragically, when I look at the data on US CPI published by the Cleveland Federal Reserve, which is the branch of the Federal Reserve which publishes most of this stuff and analysis on the CPI. The Dallas Fed publishes a lot of stuff on the core PCE deflator, but the CPI stuff comes from the Cleveland Fed. And it is true that in their measure of CPI less food and energy, what's most people use as core CPI in their bond models, that CPI inflation fell from 6.6% for the year to September to 6.3% from the year to October. But the problem is, if you're a statistician and if you were the Cleveland Fed, you'd put a lot more emphasis on what the median CPI was, what the 50% above, 50% below. What does that median CPI do as published by the Cleveland Fed? And unfortunately, it does absolutely nothing. In September for the year on year, the median CPI was 7%. And in October for the year, the median CPI was 7%. So I would say that the response of the Federal Reserve to this CPI number is pretty close to nothing. And so I think that if the explanation that the market is rising because of that CPI number, I don't think it's really telling us what's happening. But we do learn something about what's happening by looking at our model of the ASX 200. So our model currently explains just under 88% of monthly variation based on data going back to 2008 is how we run it this time. And back in September, I published a piece called Why the ASX 200 was worth 7,200 points. And what had been happening through the year up until that point was we started the year with reasonable earnings in Australia, and then what we got was a terrific increase in bond yields, and that terrific increase in bond yields knocked down fair value in terms of our model from around about 71.30 at the beginning of the year all the way down to about 6,500 by the time we got to June. Now, the model seems to lead what actually happens in the market by 3 to 4 months, which is kind of handy if you're in this business. But what happened after that, after June, was we had a really fantastic reporting season with really strong earnings for companies in the ASX 200. And so the result of that was, in a very short space of time, our fair value in our model went up to 7,300 points at the end of August. But then interest rates kept going up again, and that knocked a bit off that. So when I came to update my model in September, it was just below 7,200 points, and what we see now is it was about 7,190, and we'd actually finished the month was 7,175 points, which was still pretty heroic because by that time the market had fallen to a level which was fully 700 points lower than that. It was knocking around about 6,400 points. So my call that what would then happen was that the market would go up to 7,200. It seemed pretty heroic at the time, but that's what's happened. Now, what I said at the time was that there is normally a cycle, particularly in the US equities market, caused by the end of the US government financial year. And the US government financial year ends, rather surprisingly, at the end of September. And there's a huge amount of tax payments being made at that time. Generates an enormous amount of liquidity from the market. And that generates an outflow of cash. It's one of the few periods in which the US Treasury makes a surplus, or guaranteed surplus, in the month of September. But then what happens is every year the US government financial year begins again in the 1st of October, and then you run a pretty much guaranteed, quite significant expansion of the US budget deficit on a cyclical manner in the quarter between the 1st of October and the end of December. And I thought what would happen was, when we got into that, that the market would start to rally up towards fair value, which was just under 7,200 points. And that's pretty much what's happened. As of yesterday, when I ran the model, fair value hasn't changed very much at 7,185 points, but the market has risen from 6,400 up to 7,100. And what I expected to do is run up to fair value. And after coming from such an enormous degree of undervaluation, I'd expect it to overrun by a few hundred points into overvalued territory. But right now, the title to this piece would be why the ASX 200 is still worth 7,200 points. The call in September has fortunately been correct. The market's rallied towards that target. I think it has the opportunity to overshoot that in coming months. But we are pretty much supported where we are by very, very strong earnings and reasonable interest rates. That's the end of my comment. Are there any questions?